think that inflationary pressures do seem to be on track to last well into the middle of next year. Well into the middle of next year.
Well into the middle of next year.
Say what?
All right. Today is Tuesday, January 11th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Now let's dive right into it. In focus tonight, how about we review the freak show that we got over at Capitol Hill today, the testimony of Jerome Powell. But we start with this criminal, Clarita, who we exposed a few videos ago, and of course, all of our efforts paid off. Yes, the majority of the impact came from the bombshell article from the New York Times, but our efforts on social media, including YouTube and Twitter, paid off. And down goes Clarita. He's gone. Poof. Last day at work will be this Friday because Mr. Clarita quietly resigned yesterday. Now here's the bad news. He's going to continue doing insider trading, this time freely, with no criticism whatsoever. He's still going to get insider information from his buddies at the Fed, but this time around, at least on paper, there is no conflict of interest. And therefore, I believe that this criminal should have gone to jail, or we should push a little harder for him to be punished. Either by going to jail, paying a fine, being banned for trading for certain years, whatever punishment it is, he cannot just walk away punishment-free because the credibility of the Federal Reserve has been damaged dramatically by the insider trading scandal. Anyhow, let's move on to the testimony that we got today from Jerome Powell. Of course, he testified today wearing his favorite tie, his lucky tie, the famous purple tie. And I say it's not his lucky tie. He made the dumbest statements ever wearing this tie. So if Mrs. Powell is listening to the program, you might want to hand your husband the true lucky tie. And it comes in the same color. It is just more expressive. But let's move on to review the freak show that we got today. And of course, your beloved politicians, they're all over the place, and they are absolutely clueless when it comes to macroeconomics and inflation in particular. We start with the clown from Ohio, Senator Brown, who actually believes that the Fed's policy on inflation is pretty good for the poor. Take a listen.
We've only just begun the work of empowering American workers in reorienting our economy from Wall Street to Main Street. Some are suggesting, though, that the Fed pull back on the support of the broader economy and make it harder for people to get jobs. That's generally what happens. Economist lingo tends to mask what we're really talking about when it comes to the Fed's work. So let's be clear. President Biden put it pretty well last week. Taking the example of the price of cars, he said we have two options. We can increase the supply of cars by making more of them, or we can reduce demand for cars by making Americans poorer. That's the choice we face. When people talk about cooling off the economy, what they really mean is making it harder for people to find jobs and stopping paychecks from growing. And we know how this goes. The cooling off never seems to extend to corporate profits or executives' pay. The Fed must not allow only Wall Street to recover while working Americans are left behind. We've seen that story unfold far, far too many times.
And I say, Senator Brown, this is the dumbest statement I've ever heard in my life. You can't be any more delusional if you try. If you genuinely believe that the Fed's policy is good for the poor and the average working class citizen of this country, you're sadly mistaken. A matter of fact, you shouldn't be even serving at the Senate because you're absolutely clueless. The Fed has committed the crime of the century, the biggest transfer of wealth in history. We've never seen such transfer of wealth in a short amount of time like we saw since the start of the pandemic. And this transfer of wealth happens to be from the poor, middle class, to the ultra-rich, the 1%. Take, for example, this. 88% of Americans are worried about inflation. 88% are worried about inflation. But you, Senator Brown, the clueless madman that you are, you want the Fed to continue in the same policy and not tighten and push inflation even higher with 88% 98% of Americans, the vast majority, are worried about inflation. The Fed's policy of pushing inflation higher and propping up the equities and real estate markets with trillions and trillions of dollars that are added to the public debt of this country have pushed home prices out of whack and priced the majority of Americans out of the American dream of owning a home. First-time home buyers are getting crushed in a cutthroat U.S. market. Prices are soaring like we've never seen before. And if you think this inflation is good for the poor or the middle class, think again. Because the share of sales, these are home sales of course, to first-time buyers has plunged during the pandemic, meaning we're seeing people buying second homes, corporations, and wealthy individuals scooping single-family homes across the country, stifling average Americans from attaining the American dream of owning a home. But Senator Brown says this is good. Mr. Powell, please don't change policies. Rents are surging out of whack, and the poorest Americans are facing the brunt of the pain. They're getting evicted. They have to move from cities to smaller towns, change jobs because the rents are surging out of whack. Again, is this good for the poor, middle class, and average Americans? Of course not. But Senator Brown says, Mr. Powell, continue to keep the same policy. You're doing a good job. And by the way, Senator Brown, when you talk about inflation being good for the poor and the Fed should not slow down the out-of-whack demand and the overstimulation of this economy, and instead we have to shift our concentration to increasing supply, this is a misguided thought to begin with. But look at what's going on in this economy, in this inflation, in this mania, delusional policy from the Federal Reserve. The average hourly earnings adjusted to inflation actually went down. We're losing money. The poor, the middle class that you pretend to care about, they're actually losing wages in this insane inflation. Another one, small businesses are getting whacked, absolutely clobbered with this inflation. Some 22% of small firms said inflation is their biggest problem in the latest NFIB survey, the biggest proportion since 1986. But Senator Brown says, Mr. Powell, you're doing a good job. Don't change policies. Don't tighten. And Senator, here's who's actually benefiting from the Fed's policy. The 1%, the ultra-rich. The world's 10 richest people gained $400 billion in wealth in 2021. Elon Musk alone added $121 billion to his wealth, while Jeff Bezos added $4.5 billion. And of course, it is not a surprise that all of them, not just Senator Brown, today in this hearing, they kept saying, Mr. Powell, thank you for your service. Thank you for your service. Thank you for your service. As if he is some war hero. But we know what service it is. He's making them and their Johns richer. He indeed did a great service to those people, not to average Americans. Now, Senator Brown, when you talk about should we crush the demand for used cars and vehicle sales in general, or, as President Biden put it, we should increase the supply of cars. Well, you can't do that anyways, because the demand is out of whack. The demand is out of whack due to the tsunami of liquidity from the Fed, throwing trillions and trillions and trillions of dollars all over the place, which over 90% of these trillions find its way in the pockets of the 1%, the corporations, the ultra-rich. How do you suppose that we're going to increase supply when we don't have chips? There are no chips because the demand is out of whack. They bought all the chips. It's not a supply problem. The supply chain, even with the virus, they're capable of supplying average demand, regular demand, a little higher than average demand. That's also okay. The supply chain is more than capable and equipped to satisfy that demand. What the supply chain is not capable of is supplying out of whack demand. With all of these stimmies and trillions of dollars all over the place, everybody's chasing the same products, the same goods. What do you think is going to happen? So increasing the supply, in this case, is stupid, and it's not going to happen anyways due to the shortage of chips. On the other hand, look at this inflation. Used car prices are surging out of whack. Is this good for the poor and middle class families who are looking for a reasonable car, a reliable car, used car that they can buy to transport their families and go to work? Of course it's not. We have an out-of-whack demand problem. And yes, the end result will be perhaps a recession to fix this inflation problem. And this is why we've been saying all along, you gotta stop this madness and this engineering of the economy by the Fed. And by the way, we're anticipating the CPI tomorrow, aka the CP lie, because it doesn't reflect the true nature of inflation. If we actually calculate the true nature of inflation, average workers, their wages went down at least 10%. They're losing wages, not gaining. And the reason is the CP lie does not include or calculate properly rent, and housing inflation. Look at the contrast between the Consumer Price Index for rent of primary residence in white versus actual rent prices in red from Zillow. The CPI underestimates rent prices dramatically. Rent prices are at a minimum at double digits rate. Once again, is 10, 15, 20% rent inflation good for the poor and the middle class, Mr. Brown? Of course not. You know better than that. Here's another one. Another antique centered around, and listen to this debate on inflation. Is it a supply problem? Is it a demand problem? Of course, Powell and his allies want to blame inflation on supply. It's the virus. The virus shut down everything, and therefore supply is being suppressed, and therefore we have an inflation problem. Bullshit. But listen to this exchange right here. Take a look.
Consumer Price Index rose 6.8% in November. There appears to be a consistency along that line. Part of that you have the opportunity to impact with regard to the demand side. Can you talk to us about your discussions, or at least your analysis, of how much of the inflationary trends we're seeing you have the ability to impact with your monetary policy?
So again, we don't have much ability to affect the supply side. And if you look at where the really big contributors are to the overshoot from inflation, it's in the goods sector still largely, and that's cars, that's new, used, and rental cars. It's appliances and
What about food?
goods. Food too.
Hamburger at over $5 a pound?
Yeah, no, and that's not something we can't. I'd say that there are supply side issues there too, as you and I have discussed, but those are really outside the range of our
Be fair to say
tools.
petroleum products as well?
Yes.
Gas, price of gas at over $5
Yeah.
a gallon. Those are items that are supply side. They are not the demand side, and yet
That's right.
you have a responsibility to try to, or at least your goal is to remain inflation at about 2% or so.
Right.
But the supply side of this is a significant part of the entire inflationary demand. Fair to say that your focus is on the demand side, not the supply side, correct?
That is right. That's correct.
So what percent of that inflationary trend, what percent of that are you trying to impact with the demand side monetary policy that you have the ability to impact?
It'd be hard to break it down in that way. I would say it this way, though. Right now, our policy is very highly accommodative, so we're stimulating. We're not restraining demand at all at this point. We're encouraging it. We're trying to get to a place where we're more neutral and then perhaps tight if that's appropriate.
So far, the senator appears that he's leading into the argument that this inflation that we have right now is due to supply restraints, and it's not due to the Fed's policy. He's also leading that perhaps inflation is due to price gouging via corporations and producers, not due to the Fed's policy. If inflation ever was a supply problem, then how do you explain the fact that coffee prices in Brazil surged so high that the demand went down because people cannot afford an average cup of coffee? The price is too high and the demand went down, yet still coffee prices remain high. And by the way, Brazil is one of the largest producers of coffee beans on the planet. There is no supply problem in Brazil. They have so many coffee beans that can fill as far as the eye can see. There is no supply problem of coffee in the country of Brazil, yet prices are surging out of whack. Another one, inflation in Russia is surging out of whack. One of the components of inflation in Russia is gasoline and gas prices. Well, guess what? Russia is so rich with gas and oil, there is no shortage of supply over there. So why is inflation rising higher in Russia? Another one, why were gasoline prices in Saudi Arabia surging out of whack to the point where the government had to cap these prices for consumers? Last time I checked, there is no oil shortage or a lack of supply in Saudi Arabia. Inflation, as Dr. Friedman taught us, is always a monetary phenomenon. When the Fed prints money out of thin air, trillions and trillions and trillions of dollars, stimulating an economy that doesn't need stimulation, that money doesn't disappear in a black hole. That money lands somewhere. The majority of that money lands in the pockets of Wall Street, corporations, and the rich. Some of that money trickles down to us, the consumer. Now this money has to chase something. In the case of us, the consumer, we chase goods. We start buying stuff, iPads, iPhones, food, clothes, shit we need, shit we don't need. Now when it comes to the trillions that lands in the hands of the rich And the institutions, what do they do with this money? They're going to chase assets. In this case, they buy the stock market. Therefore, the stock market is in mania bubble territory, trading out of whack, pretty much a vertical rally since the tsunami of liquidity started by the Fed, the easy money policy. They also chase commodities. Money has to chase something. And in an inflationary environment, some of the best assets money can chase are commodities. And therefore, institutions, investors, traders, they buy oil, they buy cotton, they buy lumber, they buy metals, meats, grains, pushing all of these prices higher. All of these commodities are dollarized, so you have to pay the market price for these commodities regardless whether you have the supply or not. And hence, inflation is always a monetary phenomenon. Inflation, not a transitory one, not a short-lived one, because yes, an imbalance between supply and demand can produce inflation, but this inflation is short-lived, because the supply is going to catch up with the demand. This is in a regular setting, not in the out-of-whack setting that we have right now. Inflation in this case is not a supply push problem. It is a demand pull problem. The easy money policies, cryptos to the moon, stocks to the moon, home equities to the moon, stimmies all over the place, low interest rates all over the place. You can borrow money like it's nothing. And this creates an insane demand where it's pretty much impossible for the supply to satisfy this demand, whether we have a pandemic or not. And notice the senator is going to catch himself here. He's going to say, in my state, we have more cows than people, but somehow meat prices and burger prices are surging higher. What's going on here? Take a listen.
But it's not political in nature, it is economic in nature to say that the inflationary trends that we are seeing are partially from the ability of consumers with cash in their pockets to be able to pay a higher price. But second of all, it's because of the limitations and the bottlenecks that we find within the supply side of our economy, correct?
Yes.
So let's just take food as an example. I come from South Dakota where cows outnumber people, and yet we have producers there that on a regular basis talk about the fact that they don't see an increase in what they're receiving for livestock, and yet our consumers across the entire country are seeing huge increases in the price of meat. And in between them sit packers, 4 packers who control over 80% of the market, showing record high profits while consumers pay huge inflated prices. That's something which has to be dealt with policy and not necessarily something that the Fed can impact, correct?
That's really a competition policy question, yes.
Yeah.
And again, he comes to the conclusion that perhaps this inflation is due to price gouging and monopolies by corporations and producers. That's baloney. That's bullshit. We had the same dynamic in the meat industry, a handful of players that dominate 80% of the market. This same dynamic existed before the pandemic, and we did not see meat prices surging out of whack. So this could not be the reason, Senator. The real reason is the commodity live cattle futures. These prices are surging out of whack because money has to chase something, and it is chasing commodities. Meat providers have to buy these commodities at the market's price, which is inflated right now. They have to pass that extra cost that they're paying to you and I, the average consumer. Add to that, gasoline prices surging out of whack. Somebody got to transport the meat. That is an extra cost that is incurred by meat providers. They're going to pass that extra cost to you and I again. We have wage inflation. That's an extra input cost for meat providers. We have a labor shortage. When somebody gets a case, they have to quarantine. That reduces the supply too. All of these factors are incurring extra costs to producers and providers of goods and services, and they're passing that extra cost down to us, the consumers. Whether we have more cows than people or not, that doesn't matter. We have a trucking shortage. Somebody got to transport these meat products, be it beef, be it chicken, be it hogs, doesn't matter. Somebody got to transport these products. When we have a shortage of truckers, and oh, by the way, a shortage of trucks, and we have so many goods to transport because the demand is out of whack, you got to pay these truckers and trucks higher pay. What are they supposed to do? They're supposed to lose money? No, they're not. They're going to incur the extra cost, and they're going to pass it down to you and I, the consumer. This is the 101 nature of inflation. And here is more from Senator Warren, who's also beating on the same drum that inflation is happening due to price gouging and the lack of competition in certain industries. Take a listen.
Well, but let me ask it the other way then, because we're still kind of doing Econ 101 here. If you're a corporation that has eaten up most of the competition and cornered the market, Is it easier for you to raise prices on your customers and maximize your profits because you don't have to worry about losing your business? In other words, you've lost the discipline that the market imposes.
In principle, if you don't have competition and you're a monopolist, yes, you can raise your prices.
Okay, and over the past year, we know that prices have risen because of supply chain problems, unexpected shifts in the demand for goods, and even higher labor costs. But if corporations were simply passing along these costs in highly competitive markets, would the company's profit margins have changed much?
You know, so many things affect those that calculation. In principle, you could be right, but
Well, it's very much not what we're seeing right now. Today, nearly 2 out of 3 of the biggest publicly traded corporations in the country are reporting fatter profit margins than they reported before the pandemic, which doesn't sound like they're just passing along costs. So let me ask you, does that increase in profit margins combined with greater market concentration in industry after industry suggest to you that some corporations may be passing along increased costs and at the same time charging more on top of that to fatten their profit margins?
And all I have to say to that is, duh. If I'm the CEO of Procter & Gamble, for example, and I have all of this inflation surging out of whack, I'm not going to assume it's going to be transitory. I'm going to start to jack prices higher on the end consumer to stay ahead of inflation. This is what any business leader would do. And oh, by the way, if the zombie consumer is receptive to higher prices, then what is the harm? We're going to continue to jack prices beyond the extra cost that we incurred at Procter & Gamble because the consumer remains receptive. Why is the consumer remaining receptive to these price hikes? Number one, stimmies all over the place, loose money all over the place, lower interest rates. They can swipe those credit cards up and down, up and down. We have a bubble economy where stock market prices out of whack, crypto gains out of whack, home equity gains out of whack, farts in a jar out of whack. Of course, the consumer is going to be receptive to higher prices because they're zombified right now. They don't see the long-term picture. Everybody assumes that they got their job in the bag. They're never going to lose their jobs, so they can continue to spend like crazy and rack in more debt via using credit cards. As a corporation, of course I'm going to take advantage of that. After all, this is capitalism. Whether we like it or not, it's a criminal system, of course, but it is here. This is the game. These are the rules that we play with. And if you do want to make a change, let's do this. Today I tweeted this tweet, and it is addressed to Tillamook. Now, I am a fan of this company, having lived in Oregon for a long time, but I'm not a fan of the shrinkflation they're practicing right now. You see, some companies are jacking prices higher. There are other companies, like Tillamook, for example, who are shrinking the packages, yet keeping the same price. Or, in certain instances, even pushing prices higher on smaller packages. They're taking advantage of this inflation big time, and this will continue. Why not? Your job as a CEO of a company is to produce profits to your shareholders, to your company, and to your employees. Your job is not to be the CEO of the Salvation Army. We're not running charities here. And the only way to stop them from taking advantage of us is by taking action. Any company that practices shrinkflation or pushes prices out of whack, do not respond. Boycott these companies. Buy another product to send the message that we will not be taken advantage of. Yes, we understand that there is inflation. We're more than open to pay extra prices. We understand that, but don't abuse it. And shrinkflation is the biggest example of abuse to the consumer. I tweeted this: I love you, but I'm not falling for this shrinkflation crap. Bring back the original size and charge me a few cents more for it. Consumers, we have to stand up against inflation, or shrinkflation in this case, and boycott these companies. Otherwise, this practice will become permanent. For some reason, Twitter decided to suppress this tweet. Last time I checked, I did not get any likes for this tweet, and the impressions are so suppressed. A lot of you did not even see the tweet. Usually, my tweets get thousands of impressions. Not this one, and I tweeted it twice, by the way. And still the same problem. So if you want to do something here, pretty please do me a favor and do us a favor. Go to my Twitter page, like this tweet, and retweet it, comment, whatever you comment, doesn't matter to me. And let's send a message to Tillamook that we are not going to buy this shrinkflation crap. I'm not paying more for a smaller package. And any other company that practices shrinkflation will also be boycotted by us, the consumers. We have to start a movement here to boycott these companies. No more shrinkflation, no more price gouging above what you've incurred. And watch how shrinkflation disappears and these prices come down dramatically. This is an easier solution, Senator Warren, than cracking down against these companies or spending billions of dollars to create new competitors, which will drive inflation even higher because we now have more players. Some are funded by the government, billions of dollars, who are going to chase the same assets. And if you say that we have a supply constraint, and having more players chasing the same commodity that is already scarce is only going to push the price of that commodity even higher. Let's continue here. And notice how Powell, so far he's been saying it's a supply problem. Yes, I agree with you, Senator. It's a supply problem. It is out of the Fed's control, yada, yada, yada. Then he slips and admits that we have a demand problem. The demand is too hot, which is enabling prices to go out of whack. Take a listen.
To you that some corporations may be passing along increased costs and at the same time charging more on top of that to fatten their profit margins.
That could be right. It could also just be, though, that demand is incredibly strong, and that they're raising prices because they can.
Well, that's the point. They're raising prices because they can, and they're not being competed down.
Now, let's shift the policy. The senator brought up the question, how would the Fed's interest rates policy adapt with the changes in the macroeconomic outlook, specifically when it comes to the virus? Over and over and over again, he asked the question clearly. And watch how Jerome Powell weasels his way around not to answer the question. It's difficult to see. It is too early to say. Things could change. This is the same guy who guided inflation higher without using a formula to determine the average. And we all know how that movie ended. Inflation went out of whack. Now he says, oh, I don't have a framework on how interest rates are going to respond to the various macroeconomic scenarios. This is a recipe for another disaster here. But watch how Powell slips and also admits that the economy can do just fine even when facing the pandemic, and it doesn't need overstimulation. Wall Street doesn't need quote-unquote accommodation due to the pandemic emergency. Unbelievable stuff. Take a listen.
So do I understand, are you saying that if the pandemic remains problematic and aggressive, that would impact the timing of any decisions the Fed might make in terms of the federal funds rate?
So I'd say it could, but what's happened is the economy has made all these gains in the face of during 2021, we had two major pandemic outbreaks, two variant outbreaks, and really the beginning of 21 was dominated by a very strong wave of the original COVID. So, and yet the economy, we made tremendous progress in the labor market in 2021, and growth is at a multi-decade high in 2021. So I expect the economy to continue to be able to deal with these outbreaks. I think it is likely, though, if the experts are right and Omicron is going to go through really quickly and peak perhaps within a month and then come down after that, I think it's likely you will see lower hiring and perhaps a pause in growth and that kind of thing. But it should be short-lived. It should be, and then the economy, the forecast for the rest of the year, or certainly for the next quarter or two, would be a very positive one, very positive.
And if that happened, would that increase the likelihood of Fed action to increase the federal funds rate, or would it delay that?
If that all happens, I think what we're seeing is an economy that functions right through these waves of COVID, and my colleagues and I see that, and you see that every quarter we write down projections of interest rates. They're individual projections. They're not a committee plan or anything like that. But broadly speaking, all members of the committee see interest rate increases coming this year. The median was 3. But that's going to depend on data. It's going to depend on the progress we see on the supply side, the progress we see on inflation. And we honestly don't know. There's risk on both sides, really, on growth and potentially on inflation as well. So we're going to have to be just very attentive to what's happening in the economy and willing to adapt pretty nimbly our policy as we go through the year.
Next, let's talk about unwinding the Fed's balance sheet, because we talked about Tapering, that's not a concern to the stock market. We talked about raising interest rates higher. And hey, a 25 basis point is nothing. That's not going to do it. But unwinding $9 trillion worth of assets, that is the real danger here. And the question clearly, Mr. Powell, are you going to unwind the balance sheet via dumping bonds or holding till maturity? A simple question that Powell did not even answer. Again, he weaseled his way around by keeping the door open to any possibility. No clear guidance, no formulas, no frameworks. This is a delusional madman who's eyeballing the monetary policy. Take a look.
When Chairman Bernanke first introduced quantitative easing back in 2009, he assured lawmakers at that point that it would be both temporary and rare. Essentially, it was introduced as an emergency measure. Do you agree that that quantitative easing should be both temporary and rare?
I agree we shouldn't use it unless we need to, but I will say it's going to depend to some extent on where interest rates are. We've been in a very low interest rate environment even during good times all over the world, and when that's the case, we don't have a lot of ammunition to support the economy. So I can imagine a regular garden variety downturn, which we haven't had in a long time, in which we didn't need to resort to quantitative easing to asset purchases, and we then wouldn't. But in a world where you've only got a couple hundred basis points to cut, you may need to do that, because what that gives you is the ability to move longer run rates down, not just at the short end.
I understand, but I just remain concerned because here we are 12 years later from its first introduction. The Fed's balance sheet's nearly at $9 trillion. We're continuing to grow it, albeit at a slower pace. So it remains a real concern. You said earlier to Senator Shelby that you think the Fed could begin the process of normalizing its balance sheet later this year. Can you provide us with a little bit more clarity on this process, how soon you think this would begin, and whether you'd consider actively selling securities rather than just letting them gradually run off the balance sheet?
So this is we had our first discussion of this set of issues at the December FOMC meeting. We'll talk about it again at the January meeting in a couple of weeks. Haven't made any decisions. This time is going to bear some similarity to what we did last time, but it's going to be different too, and that's already clear in that we will have the ability to move sooner and to move a little faster than we did last time. So more clarity is coming, soon on that, but I don't want to get ahead of the committee. In terms of selling assets, we haven't made any decisions on that. We didn't do that last time. We never ruled it out either. Mm-hmm. So it's just something we'll be looking at. The balance sheet's a whole lot bigger this time, and also the duration is shorter. So it's a different, and the economy is much stronger. Yeah. So it's a very different situation.
And here is the last one, perhaps the most ridiculous one. This is Senator, whatever her name is, from Nevada. What a piece of work she is. A whack job. She actually believes that to defeat inflation, we have to get jabbed and wear masks. No, I'm not making this up. She actually said that. Take a listen.
He asked you about comments about what the economy was like pre-pandemic, during the pandemic, and then after. And you actually said something I think was important, that we are still in a pandemic. And even still in the middle of this pandemic, you said earlier in your opening remarks that the economy is expanding at its fastest pace in many years, and the labor market is strong. Now, in our many conversations, you have always prioritized job growth and higher wages, especially for those who tend to earn lower salaries. And you have consistently said that the best thing any one of us can do to increase employment, raise wages, improve our supply chains, and reduce inflation is to get vaccinated, to wear masks, and follow the medical guidance to prevent the spread of COVID-19. Do you still believe that reducing COVID-19 infections will have the greatest impact on inflation, supply chains, employment participation, and wages?
I do, and I think if you imagine a world in which we no longer have to deal with a pandemic, and I think that's the answer to your question, we would quickly see the supply side problems alleviate. We'd probably see significantly more labor supply. So these issues are still related to the pandemic. It's proving more difficult than we had hoped to end the pandemic, but I certainly would think that's right.
This is absolute delusion, of course. Doesn't make sense at all. And here's the evidence. This is the headline from the New York Times back in September of last year. It reads, "Will high V rates help Spain weather new variant? Spain surpassed others in Europe by avoiding politicizing the debate about the thing shots. Citizens also largely heeded the health guidance from their leaders. And this is exactly what they keep telling us. If everybody rolls their sleeve and they get the shot, they wear their masks, the pandemic will be over and inflation will be gone." Absolute delusion once again. Here's the answer, by the way, for the New York Times. Cases in Spain surged out of whack. A massive explosion higher in cases, regardless of the jab rate. And oh, by the way, here's inflation in Spain. The headline reads, "Annual inflation in Spain rises 6.7% in December, the highest level in nearly 3 decades. And again, folks, these are your beloved politicians that you trust and you vote for every single time. They're absolutely clueless. They have no knowledge whatsoever about macroeconomics or inflation. Jerome Powell vows to prevent inflation from becoming entrenched. Mr. Powell, it is already entrenched. Whether we're talking about gas, used cars, food, clothes, rent, it's all over the place. You're already too late here." And Powell says this is the delusional madman, of course. He claims that he can cool inflation without damaging the labor market. This is a fantasy. The moment you raise interest rates higher aggressively, you unwind the balance sheet, the stock market will crash. When the stock market crashes, all of a sudden companies will have to reduce the risk to preserve capital. And the easiest way you can do that is by laying off employees. And you and I know that if companies and employers learned one thing from the pandemic and the lockdowns, is the fact that they can be more efficient with the labor force. They can have employees working from home. They don't need as many employees, but so long as the equity price for their stock is at a whack higher, they can continue to borrow money. The easy money is here. They can hire whoever they want to hire. But when the easy money policy is gone, they're going to get rid of employees. And we will dip into a recession. Simple as that. And if the Fed has done anything good here, is the fact that it managed to unite the left and the right. It doesn't matter what cult you're in. The blue cult, the red cult, doesn't matter to me. I'm not in any one of them, but all of us are united in the fact that the Fed is too late here. The Fed is behind the curve. Democrats think that. Republicans think that. Independents also think that. So congratulations, Jerome Powell. You have done such a lousy job that you managed to unite the United States of America. Okay, so unfortunately, decoding this freak show took a lot of time, and now we're running out of time. And therefore, I'm going to cut it short. I'm going to stick to the charts and wrap it up. And here it is. Let's start with the SPY 30 minutes chart. What's going on here? The rebound continues. We're now trading above 466.5. The chart closed the gap and managed to recapture 466.5 as support. All of this is bullish. And as you can see, these rebounds are impulsive because they combine dip buying, call options buying, and short covering. Here's the problem. Let's say that my prediction comes out correct, that the CPI month over month will go down, and this will push the 10-year yield down, and we will see a massive rebound in the stock market. The problem here is we front-loaded a lot of the gains. The SPY, since the rebound started, gained almost 3%. So we already front-loaded 3% ahead of the CPI reading. What does that mean? The bar just got pushed higher. For example, let's say, hypothetically speaking, of course, that what would have excited the market and produced a pump higher tomorrow is a month-over-month reduction in inflation by about, let's say, 1%. Now that we've already front-loaded 3% in the SPY and more than that in the Qs, the NASDAQ, the expectations are going to be pushed higher. And instead of 1%, the bar just got pushed to 1.5%. If we see a reduction of 1.5% month over month, then the market blasts higher. This is, of course, a hypothetical example, but I'm just trying to illustrate for you the game of expectations. The stock market is a game of expectations. I wish that the stock market traded flat, maybe to the downside today. Because if that was the case, it doesn't matter what number it is. Any CPI reading down month over month will push the market higher. But now the bar just got pushed higher. Moving on to the daily chart for the continuous contract for the S&P 500. What's going on here? We are firmly trading above the bull to bear advantage line, which happens to be 4,657. The bulls are in charge for now. We are close to all-time highs in the SPY. The momentum indicators are getting a little stronger, but the bears still have the advantage when it comes to the momentum indicators. Look at the volume. The buying today happened on larger than average volume. Is this bullish or bearish? The answer is, it is bullish. Here's the bad news though, for the bulls and the bears. All the technicals are not going to matter tomorrow. What's going to matter is the CPI reading what the cooks are going to serve us. Let's say we get a hotter than expectations reading. Let's say inflation moved higher month over month. Then we're going to violate the support of 4,657, and perhaps the chart will trade all the way down at 4,550. That will be the next support. However, if the market receives good news that inflation is cooling down month over month, and the 10-year yield, this is the important catch, you gotta see the 10-year yield trading down. And if it does, then the sky is the limit here. The SPY could blast all the way to all-time highs. Moving on to the Qs, the Nasdaq 30 minutes chart. What's going on here? After the rebound from 369, the chart is not looking back because we have lack of resistance. We had lack of support on the way down. Now we have a lack of resistance on the way up. And this formation is bullish. It's a bull flag formation. The problem is we have already front-loaded almost 4.5% worth of gains ahead of the CPI. So the bar just got pushed higher. This is the risk here. What about the daily chart for the continuous contract for the Nasdaq? Again, building on the rebound yesterday and now trading above 15,500. We're looking at 15,975 as resistance. That could come hand in hand with the sloping line of resistance. We could meet that line coincidentally along with 15,975 if the market shoots up higher tomorrow. Today we saw buying on higher than average volume. These are good signs for the bulls. If the bears can hang around here because they still have the momentum indicators, which are all in negative territory. And again, the technicals are not going to matter tomorrow. It's all about the CPI. And here's a 30 minutes chart for the Russell 2000. What's going on here? Moving higher, no resistance at all, getting closer to 218. It did not recapture 218, but this was good enough for now. The CPI will have a dramatic impact on this chart. Either it's going to recapture 218 by the end of the day tomorrow, or we're looking down at 211 once again for support. Moving on to the Dixie, the dollar index. What's going on here from a daily chart perspective? We now have a confirmation that 96 is no longer support, it is resistance, because regardless of the testimony from Powell, the dollar went down anyways, and this is good for commodities. Look at the action in crude oil prices. Massive gains today, both the WTI and crude oil Brent, all trading above 80 once again. Will the CPI impact the chart of the US dollar? Of course it will. A hotter than expectations reading will push the dollar back above 96. On the other hand, a cooler reading will push the dollar below 96, and we will have once and for all a solid confirmation that the dollar would trade down. The problem is, in that scenario, with the dollar going down, we will see a rally in crude oil, metals, commodities in general. When commodities move higher, so will inflation expectations. And of course, my thesis on why the CPI could come down month over month is the fact that energy prices went down. But look at what energy prices did in the month of January so far. They're firming again. What does that mean? Any dip in inflation is transitory, and therefore any pop and rebound in the stock market is also transitory, specifically in the high multiple pockets of this market. Moving on to gold, what's going on here? The old man is surging higher again. It didn't need to go all the way down to 1,763 to catch support. And I tend to use gold as a leading indicator of the movement in the dollar and the 10-year yield, because the old man, the mature guy in the room, doesn't like to move decisively so, like we saw today, without either advanced knowledge or conviction that the dollar and the 10-year yield will actually go down. So perhaps gold is predicting that the dollar would go down and the 10-year yield will also trade down tomorrow. We will see if gold is right or wrong. And here it is, the chart of the 10-year yield, the most important chart in the market right now. Look at the momentum indicators. They're all overbought. So again, this could be an explosive move one way or the other, specifically to the downside, in case the CPI is down month over month. The risk, though, what if what we're seeing right now is the beginning for bull flag formation? Perhaps the 10-year will pull back all the way down to 1.7, and then it rebounds higher, forming that bull flag formation. that will be a bad scenario for the stock market. So you gotta watch this chart like a hawk, ironically so, because it will lead you whether you should buy the dip or sell the rip. Here's a weekly chart for the TLT. What's going on here? It is climbing higher, erasing almost half of the losses from last week. The problem is, it's all about the CPI. The technicals don't matter at all. It appears that we are in a double bottom formation, perhaps catching support from the same level that the TLT caught support from before. I'm just reading the tea leaves for you here. And if that is the case, then the TLT pops higher, yields go down, the NASDAQ also moves higher. What about the VIX 4 hours chart? What's going on here? We are now below 20. The MACD indicator is showing red impressions on the histogram. What does that mean? It doesn't look so good for the VIX here, but it looks good for the SPY. This is at least for now, but once again, I'm going to bore you with it. The technicals are not going to matter. It's all about the CPI. And here is the VXN 4 hours chart. What's going on here? Unlike the regular VIX, the MACD indicator remains positive, showing green impressions on the histogram. Yet we have lost a lot of the juice here. It appears that the pop is peaking, and thus the NASDAQ bottoming. That could all change based on the CPI. Here is the chart of Apple, a daily chart. What's going on here? It reclaimed 172.4 as support and now facing the resistance of the sloping line once again. Is it bullish? Is it bearish? Well, the action from a candlestick pattern is bullish. But again, the risk versus reward, now that the pop happened and the chart is facing solid resistance, the risk versus reward says you should have taken some gains off the table today from this trade. Because when we look at the momentum indicators, they're still negative. The RSI in negative divergence, the MACD, similar story here. So who's to say that this resistance line is not going to work again and we will see Apple moving down tomorrow? Next, we have Tesla, 30 minutes chart rebounding from 995 and consolidating in a bullish formation, awaiting the CPI. A lower reading will push this name higher. The next resistance is 1,090.5. A harder reading will move us down, and we have 995. If that doesn't work, then we have the gap below. Tulips, what's going on here? As I said yesterday, we are in a bottoming process. It means that the chart is looking for buyers, any buyers, any buyers, any buyers. And today the buyers showed up. We have higher than average volume on the buying side. We're now trading above 42,000. The momentum indicators are curling upward. Perhaps they're bottoming here. The problem remains once again. What if the CPI comes out too hot? Then Bitcoin is not going to do so good. So the CPI will be the confirmation whether this is the bottom for BTC or not. And lastly, we have AMC, 30 minutes chart. What's going on here? We had a pop in the morning that faded away quickly. No buying, no bullishness here for AMC. Regardless of the fact that we are in the anniversary of the meme stock mania 1 year ago, but this is not exciting the apes and the likes to buy AMC at GameStop again. When we look at the monthly chart for AMC, it doesn't look good either. The MACD indicator appears that it's about to cross the negative territory, and if that happens, then this will serve as a confirmation that the run is over in AMC once and for all. The chart is now trading below the 2017 levels, and we are now below the March levels of last year. So the majority of holders here, the hodlers with the diamond hands, they're actually holding a massive bag here. The majority of them are holding bags. And at some point, if this continues to move down, we will see the capitulation from the apes saying, you know what, it's not going to happen. Let's take whatever is left here and move on. And if that happens, we could see a massive flush down here. It's getting really dangerous for these meme stocks. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Just in case you weren't paying attention throughout the video. We have the CPI, this is the most important reading, the Consumer Price Index, aka the CPI, and then we have the Beige Book from the Fed. You also have another zombie from the Fed speaking, Neil Kashkari, the demon from Minneapolis. Before I wrap it up, let's do a preview for the CPI quickly here. The expectations are that the CPI will cool in December. We're talking about month over month. Forget about year over year. That reading will be hot. We're talking about month over month. Now, the economists, the experts, they say that the reading we're about to get tomorrow will be the peak of inflation. I disagree. I think we will have a dip and then inflation will move higher again. The last thing I want to discuss with you here is market expectations. We talked about the market as a game of expectations. What are the expectations as of late? They're moving in the hawkish side. Take, for example, this chart right here. Market participants on January 3rd were not buying the Fed's dot plot. They still believe that the Fed will remain accommodative. They're just bluffing, yada, yada, yada. On January 10th, those expectations moved higher. above the dot plots. So we're seeing an adjustment here on the hawkish side. Likewise, when we look at the euro-dollar 2021-2022 spread, we're now pricing 4 rate hikes, not 2, not 3, 4. Is this hawkish or dovish? It is hawkish. Another one, the spread between the 13th and the first Fed contracts. They're moving higher, pricing more than 3 hikes this year. So the expectations moved on the hawkish side dramatically. We're pricing in 3 to 4 hikes. Forget about the 10-year yield for now. This is being distorted and manipulated by the Fed and other factors. But when we look at the contracts for futures and spreads, market participants are actually anticipating a more hawkish stance. 3 to 4 rate hikes. What happens if the CPI comes out cooler than expectations tomorrow and the cooks give us a cold meal? All of these expectations will be scrambled. We will see an adjustment of the adjustment. It will be toward the dovish side. Perhaps we're not going to get a March hike. Maybe we'll get a June one, etc., etc. This adjustment will produce a massive pop in the stock market. Now, let's discuss the other scenario. What if these expectations are correct and they're done because the CPI will come out hotter than expectations? Not just year over year, but also month over month, regardless of the dip in energy prices. Oh boy, if that happens, don't just cue the Elmo with a fire or the nuclear bomb. How about cue the end of the world? Cue the asteroid, because it's gonna be ugly, ugly, ugly. We have a big day ahead of us tomorrow, folks. So this is enough for now. This is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.